Welcome to the Nichols Tax Update Podcast for November 2nd, 2020. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncement, expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, a publication of tax analysts, the preeminent source of information for tax professionals in the preparation of this program. Well, it was an interesting week. The IRS is starting to give us information that we need for upcoming tax season, and golly, we just finished the last tax season. But it's a good time to start grabbing this information because you're going to want it in February and March of the coming year. A couple of items in this, but not everything. The IRS is announcing balance due operations beginning in a press release. They're going to be back to sending balance due notices. Partnership reporting, new IRS enforcement priority, not just the partnership negative tax capital, but other partnership reporting as well. Inflation-adjusted items for 2021. Revenue Procedure 2020-45. This is one of those things that you're going to need come the tax filing season. Questions? Clients will want to know why this year's amount is different from last year, and you'll want to know how inflation adjustments may have increased the benefit for a particular credit or deduction. Draft Form 1040 instructions are out. Press release, October 27, 2020, 3 new lines that require some additional information. You want to be thoughtful about accumulating that information before you're in the trenches in tax season. Tax Notes Today published a wonderful article by Robert Wood on penalty abatement. Very thoughtful, very, very simple, not filled with the references that nobody understands or words that nobody can spell. Robert Wood goes at this question of when can you legitimately request a penalty to be abated, and how do you go about it? What is reasonable cause? What is good faith effort? Those are terms of art, as a matter of fact, and they have been well established by litigation and by IRS pronouncements and by the way taxpayers in the IRS have interacted on this issue of penalty abatement. C. Lucero, this is a crazy case. It revalued a settlement. I want to talk about some of the issues, some of the valuation issues, and what happens on both sides of the transaction when a company, well, first of all, they got themselves in hot water. They never should have allowed themselves to become a target for this kind of a lawsuit. You want to think about that. But Mrs. Lucero really cleaned up. She got a lot of money from a company that was failing, as a matter of fact. We'll talk a little bit about that. And then in Shirehampton Drive Trust, we have a situation where the IRS established its lien priority ahead of the Homeowners Association. This is any of you that have clients that are condos, homeowners associations. If you have dues, if you have maintenance assessments, you need to file your liens sooner rather than later. Especially someone gets in trouble, they can't file their maintenance, pay their maintenance. They're probably not paying their income taxes either. And so you want to get ahead of the IRS if you can. All right, let's see what we've got here. The IRS is going to jumpstart sending of the 500 series notices. 3 types of alerts. Varying stages of non-payment. Those are temporarily blocked because of the mail backlog, and the IRS was simply not, they didn't have the information they needed to legitimately disturb taxpayers about amounts that were not paid. Well, let's see what those 500 series notices start after the CP14, which is the initial notice and demand for payment. The 501 series notices are sent to taxpayers who do not respond to the CP14. The 501 alerts taxpayers to the fact that they still have a balance due. The 503 alerts the taxpayer that the IRS has not heard from the taxpayer, and if the taxpayer does not respond, the taxpayer will be subject to a lien. The 504 is a pretty harsh notice. You haven't paid your taxes. If you don't pay them, we're going to levy against everything you own. We're going to levy against your paycheck. We're going to levy against your bank account. We're going to levy, and we could levy and sell your house if you don't pay your taxes. So it's really important to respond to those notices. And I thought maybe you would like to know. The client calls and says, I have a letter from the IRS. You can say, what number is down there on the bottom in either the lower left-hand or the lower right-hand corner? Tell me what the number is, and I can tell you how serious your problem is, right? IRS enforcement priorities are going to include partnership reporting in a big way in the coming season. Tax Notes today, in an article by William Hoffman, he's done a really good job of interviewing some IRS senior personnel to find out what the IRS's enforcement priorities are likely to be. And the news is the IRS is pivoting, and that's the word that Mr. Hoffman used, is pivoting its enforcement to partnership reporting. In particular, as I think we all know already, the IRS is focused on reporting of partnership capital accounts. Again, in particular, partnership negative tax capital accounts where it is possible that a partner could ignore the tax law by accident, of course, and not having and not when being relieved of negative basis, which should be a taxable event. And there, of course, there's no such thing as negative basis. That's one of our problems. But there can be negative tax basis as it is defined by the IRS. So they're really after negative tax basis where the partner has bought into a partnership with very little money. The partnership gets debt financing on depreciable property, passes losses through to the partner. The partner's capital account goes down, even though the partner's basis can never go below zero. But when that property is sold, in the push me pull you of accounting for everything, it's possible that the partner with negative tax capital will not pay tax on the phantom income resulting from no longer being obligated on the debt. That's an oversimplification, I know, but for those of us that aren't strong technically, it should do the job to alert us to what the IRS is interested in. The IRS also, by the way, this is good news, they're concentrating on intra-agency communication, which will coordinate case files and move them more expeditiously, which may not be good news, from identification of the issue to exam, from exam to appeals, then to litigation, and finally to resolution, whatever resolution involves in that case. And the IRS has released inflation-adjusted items for 2021. 62 changes explained on 27 pages. Everything from individual tax brackets to foreign earned income, from the kiddie tax to notice of large gifts from foreign persons, from the education credits to penalties for late filing. No practitioner should undertake to be giving advice at year end where you're calculating tax liability on the back of a napkin or fielding phone calls early in 2021 without familiarity with Revenue Procedure 2020-45 and the inflation-adjusted amounts therein. Everything you want to know about the inflation adjustments is in Revenue Procedure 2020-45. Next, news. This time every year, the IRS releases the draft Form 1040 and the instructions for the Form 1040 for 2020. This information gets to us in the form of a press release, and I checked at www.irs.gov, and lo and behold, there are the draft instructions, all 111 pages with a clickable index. It includes a new cover page with some fancy artwork. Doesn't make it any easier to understand, but it makes it prettier. The clickable index then makes it user-friendly, which is nice. There are 3 new lines on the Form 1040. The first one, I think we may have talked about this a couple of weeks ago, the first new line is right at the bottom of the general information, just above the standard deduction. It's not a numbered line. It asks the taxpayer to report any virtual currency transactions. If you held the same virtual currency at the end of the year that you held at the beginning of the year, and you had no virtual currency transactions, you don't report anything on that line. That's only if you had transactions. Then line 10B, which is on the back of page 1, is used to report charitable contributions of up to $300. It was $250, now it's $300. If you claimed the standard deduction, so you get $300 worth of charitable deductions in addition to the standard deduction if you actually paid them. This is not something that you take just because you're entitled to it. You have to have the proof. If you're audited and you don't have the proof, there can be serious consequences. Line 30 is where you claim recovery rebate credits. So those are the 3 new lines on the Form 1040 for 2020 that we will file beginning in 2021. Then the layman's guide to reasonable cause. Tax Notes Today, an article by Robert Wood. IRS, by the way, just released a practice unit. That's a PowerPoint slide training module they're using to train their people on this topic. So the IRS is going to emphasize efficient assessment of penalties in every case where penalties can be assessed. They're training their people to do this. We need to train ourselves and our clients to resist the assessment of a penalty where we have reasonable cause for a return position. So you got quite a dust-up going on in the tax community about the definition of reasonable cause. Lipton, who wrote a lot about partnerships back in the day of passive losses, is also writing on reasonable cause, and there's been quite some high-level professional discussion in Tax Notes Today and Tax Federal about this particular issue. It will be a hot issue in 2021 and 2022. Most tax positions require the taxpayer to have reasonable cause, but also to have acted in good faith, exercising ordinary business care and prudence, and to disclose the position on a Form 8275. If you don't disclose the position and you don't have a higher level of assurance than just reasonable basis, you're going to lose the penalty argument. So out of an abundance of caution, make plans to disclose your return positions if there is any question in your mind, or might be any question in anyone else's mind, about the technical underpinnings of the position that you're taking in the return. Be careful. The wording of relief provisions is different for different penalties. There's the penalty for underpayment. There's the penalty for overestimating the value of a credit, claimed credit. There's a penalty for filing late. There's a penalty for not giving independent contractors their Forms 1099. And all of those penalties have different required, different standards for granting relief from the penalty. If you want relief from the penalty, you got to meet the standard that's in the code, and it's not the same for every penalty. Now, having said all that, the IRS is also going to consider some other things. They're going to consider your compliance history. If this is the first time you've ever filed late, you're probably going to be able to wrangle relief from the penalty. But if you filed late 2 out of the past 3 years, you're sunk. They're not going to abate the penalty. If you had a misunderstanding about the tax law 2 years ago and another one 2 years before that, if you're constantly showing up asking for relief from penalties, you're not going to get it. the once in a lifetime is what I would suggest. And if you want to get past the once in a lifetime rule, you had better have some really good circumstances and a really good argument to make about why you should not be assessed, or why a particular penalty, which has been assessed, should be abated. Very rarely do we get ahead of it and argue against assessment. We're always arguing for abatement. Now here's the Lucero decision. This is really something. They negotiated. The company fired her. She had breast cancer. She had surgery. She had chemotherapy. She was having trouble taking care of her work, and her boss summarily terminated her. Dealing with her illness was disrupting the company. Boy, was that ever a mistake. 2 months after her termination, she filed a bell ringer of a lawsuit. Ultimately, that was settled, paid her $500,000 cash. Well, first of all, she had 877,000 stock options. She cashed those for a couple of $1 million, so she had plenty of money to fund her attorney's fees, and she sued her former employer. Ultimately, they settle after back and forth for about a year, which is really pretty quick. She got $500,000. Her lawyer got, I think it was like $1.5 million, and she got 650,000 shares of her employer's stock. Not bad. They valued that stock at $2.38 a share. At the same time, and they were negotiating, and they actually negotiated this settlement in open court. So the judge was involved. They made a record of the negotiation, and everybody signed off with the customary caveats that and the releases from the beginning of time till the end of time. And so Ms. Lucero signed off. She's released her former employer. She's got her 670,000 shares of stock at $2.38 a share. But wait, within a month after that negotiated settlement, her former employer files an S-1 with the Securities and Exchange Commission admitting that their business is in the tank, and in fact their stock is worth a lot less than $2.38 a share. Well, you can imagine that Mrs. Lucero felt deceived. And so she brings a lawsuit. She doesn't want to report as income a value of this stock which isn't there. It's smoke and mirrors. She's willing to pay tax on the real value, but not on the hyped up value. And when the public got a look at the S1, the value of the employer's stock dropped like a stone. So the information that was submitted to Ms. Lucero in settlement negotiations was substantially different from information that was being entered in an SEC S1 at the same time. The employer knew that the information submitted to Ms. Lucero was bogus. Now the employer shows up in court with well, not exactly without clean hands, but the employer shows up on the wrong side of the ball here. The employer has been deceptive. This poor sick woman who's already socked them for over $1 million is entitled to better consideration than this. Now, the judge did not upset the settlement. She got 670,000 shares of stock. What the judge ruled was she had been deceived about the value, and the true value wasn't $2.38 a share, but was something like 57 or 58 cents a share. That's a big difference. It's over $1 million. So the judge did not upset the deal. The judge upset the valuation of shares given in the deal because the employer was deceptive in the judge's view. You never want to get on that side of the ball. You try to stay on the side of the angels if you can. Finally, IRS liens have priority over an HOA loan. I happen to be treasurer of my condo association, And we had never really focused on this in our condo. We don't have many people that get behind very often. We have one that is kind of periodically behind and then they catch up. But there's a lesson here for all of you who are on condo boards, all of you who live in condos, all of you who might be treasurers of condo associations. File your liens sooner rather than later. Someone who's having trouble paying their maintenance monthly or quarterly is likely to be having trouble paying their income tax. The IRS is not bashful at all about filing liens. In fact, a tax lien attaches to all of the taxpayer's property when a tax is assessed. The IRS really doesn't have to even go to the county courthouse and file the lien. But in this case, the IRS did go to the courthouse and file the lien. The first lien filing was March 1st of 2009. The HOA did not file a lien until July of 2009. That's it. Yeah, July. The HOA filed its lien in July of 2009. The IRS had filed in May and June. So the HOA is late. And you're filing liens on real property. First in time is first in line. So Shirehampton Drive needs to have a policy, a matter of policy, that when a owner does not pay their monthly assessment, they file a tax lien right then. So they take no chance of getting behind the IRS because, well, behind the IRS, there'll be nothing left. The IRS will strip the bodies and there'll be nothing left for you. Well, that's it for this week. Until next week, please stay safe.